The quiet rise of regional titans. It began in the margins of the financial map, far from the towering institutions of the nation's largest cities. Modest banks rooted in growing towns and ambitious territories started to expand their reach, serving communities overlooked by the established financial centers. Their growth was gradual, almost unremarkable at first. But behind that quiet ascent lay a transformation that would reshape America's economic landscape. To understand why these regional institutions mattered, we must return to a nation stretching westward, building new industries, and redefining what prosperity could look like. The major banks in coastal cities dominated national finance, yet they could not reach every frontier or anticipate every local need. Into that gap stepped regional lenders, institutions nimble enough to adapt, bold enough to take risks, and deeply intertwined with the communities they served. Their influence grew through relationships rather than reputation. They financed mills, farms, mining ventures, and small manufacturing plants that national banks considered too distant or speculative. They understood local rhythms, when crops came in, when markets tightened, when winter strained families and businesses. This intimate knowledge allowed them to offer credit where others hesitated, becoming lifelines for entire regions hungry for growth. At first, their rise seemed purely beneficial. Towns flourished, trade expanded, new industries took root where once there had been only scattered settlements. The regional banks earned trust not through grand statements but through presence, being there when needed, adjusting terms when seasons turned harsh, extending opportunity to those who had been ignored. But beneath this momentum lay deeper forces gathering. The balance of power between local banks and national giants began to shift in subtle ways. Lending networks expanded, branches multiplied. Capital from booming regions flowed back into the institutions that had nurtured their growth. The once humble banks started to resemble something more formidable, a new class of financial players whose influence stretched far beyond their original borders. These early beats revealed a quiet rise, but also the first hint of a looming tension. As regional banks grew stronger, questions emerged. How large could they become before challenging the established order? And what would happen when their local ambitions collided with national power? The answers were approaching, carried by the steady but unmistakable transformation now unfolding across the expanding American frontier. As regional banks expanded their reach, their growing influence began to reshape the economic pulse of entire territories. What had started as a collection of community-focused institutions now evolved into networks capable of directing capital on a scale once reserved for the nation's financial giants. Their decision-making no longer affected only single towns or scattered farms. It began to guide the fortunes of whole regions. The shift was subtle at first. A larger loan here, a new branch there, and partnerships with emerging industries that required reliable financing. But each step strengthened their position. Railroads looked to them for expansion funds. Timber companies, mining outfits, and agricultural processors relied on their credit to fuel their operations. These banks understood the terrain, the people, and the cycles better than distant lenders. And this knowledge gave them an advantage that was growing harder to ignore. With success came new complexity. Regional banks began pooling resources, purchasing stakes in local businesses, and forming alliances with other institutions. Some created informal networks to share risk, while others built quiet empires through carefully crafted mergers. Their balance sheets grew, their influence deepened, and their leaders became figures whose decisions had impact far beyond their own counties. Yet for all their ambition, the foundations they operated on remained surprisingly stretched. Economic swings exposed these vulnerabilities. A downturn in a single industry, mining, timber, rail, could strain the banks tied most closely to it. When commodity prices dipped, repayment schedules faltered. When crops failed, entire regions felt the pressure. Some banks weathered these storms with agility. Others found themselves forced to tighten credit in ways that strained the very communities they had helped build. The delicate relationship between growth and risk became clearer with each shift. Rumors of instability began circulating in newspapers. Editors speculated whether regional banks were expanding too quickly, leveraging too much, or allowing enthusiasm for growth to overshadow caution. These whispers traveled through markets and main streets, leaving depositors uneasy. Bank presidents published reassuring statements, but reassurance alone could not ease every fear. Meanwhile, national institutions took notice. They watched as regional banks absorbed local business, redirected flows of capital, and built customer loyalty that once belonged to the giants. The established powers saw competition emerging in places they had long dismissed as peripheral. Some responded by courting the strongest regional players. Others quietly prepared strategies to regain control, strategies that would soon intensify the pressures already building beneath the surface. As the networks expanded, a quiet tension settled across the financial landscape. Regional banks had not yet challenged the national giants, but the trajectory was clear. They were no longer modest institutions serving local needs. They were evolving into formidable forces whose ambitions and vulnerabilities were beginning to shape the wider American economy. The storm of conflict was still forming, but its outlines had begun to appear. What happened next would test not only the strength of these rising institutions, but the balance of power within the entire financial system. The strain that had quietly accumulated within the regional banking networks now began to surface in unmistakable ways. As their ambitions grew, so did the weight of the risks they carried. Risks tied not only to local industries, but to the expanding structures they had built around themselves. What had once been a story of steady, organic growth was transforming into a battle between momentum and control, between opportunity and overreach. The first signs of trouble emerged in the industries that had fueled their rise. A mining downturn in one region triggered late payments on loans that had been extended with confidence during the boom years. Timber prices fell in another, slowing production and tightening cash flow for businesses deeply connected to the bank's credit lines. These disruptions alone might have been manageable, but regional banks had tied their fortunes so closely to local sectors that even minor economic tremors now carried far-reaching consequences. As pressure mounted, internal tensions grew within the banks themselves. Boards debated how aggressively to respond. Some argued for preserving community trust by maintaining flexible terms. Others insisted that immediate tightening was the only path to survival. Neither choice came without cost. Managers watched borrowers struggle under revised conditions, while depositors, sensing the shift, began asking pointed questions about the stability of institutions they had trusted for years. Rumors spread quickly in this uncertain environment. A delayed shipment from a major mill became speculation about insolvency. A cautious statement from a bank president was interpreted as a warning. Even healthy institutions felt the consequences, as fear moved from town to town faster than facts could keep pace. The whisper of weakness was enough to trigger withdrawal lines in communities that had never experienced such scenes before. Meanwhile, the national giants, long accustomed to dominance, saw an opportunity in the unfolding instability. Some approached vulnerable regional banks with offers of partnership or acquisition. Others quietly reduced correspondent relationships or tightened terms for interbank loans, decisions that increased pressure on institutions already struggling for balance. What had started as competition was evolving into a test of endurance, one that favored the players with deeper reserves and broader influence. Political leaders, caught between local loyalty and national interests, entered the debate with mixed views. Some praised the regional banks for empowering communities long ignored by coastal institutions. Others accused them of reckless expansion that now threatened economic stability. The conflict grew louder as hearings, editorials, and public meetings dissected the origins of the strain. Each explanation illuminated a new facet of the problem: overconcentration, uneven reserves, rapid scaling, or the simple difficulty of managing a banking empire built on local needs but expanding into national territory. Across the landscape, the consequences rippled outward. Small businesses hesitated to take on new loans. Rail projects delayed schedules. Families deferred purchases. Confidence, the quiet force that had fueled the rise of regional banks, now wavered under the weight of uncertainty. The institutions that had once symbolized independence and local empowerment now found themselves standing between two worlds. Too large to respond with the agility they once enjoyed, yet too small to withstand the mounting pressures of a shifting national economy. The conflict had reached its full height. The question was no longer whether regional banks could continue their ascent. It was whether they could survive the forces now converging upon them. forces poised to push the entire system toward a moment of reckoning. The reckoning arrived when one of the largest regional banks, an institution once celebrated as a model of frontier ambition, announced a sudden suspension of payments. The news spread with staggering speed. Crowds gathered outside its branches. Depositors demanded answers. Competitors braced for impact. And across the financial landscape, the quiet rise of regional power collided with the harsh reality of overextension. The collapse sent immediate shockwaves through the territories it had helped build. Mills halted production as credit lines evaporated. Farm cooperatives postponed shipments. Merchants who relied on steady financing now faced shrinking inventories and uncertain futures. The bank that once embodied local strength had become a symbol of vulnerability, and its fall cast doubt on every institution that had followed a similar path. Other regional banks scrambled to distance themselves from the failure. Some issued reassuring statements. Others shored up reserves or sought temporary alliances with national institutions. But these efforts could not contain the spreading fear. Deposit withdrawals surged across multiple states. Even banks with solid foundations felt the tremors as uncertainty overshadowed logic. Confidence, the force that had fueled their ascent, had slipped beyond their control. National institutions seized the moment. Those that had watched regional competitors rise with quiet unease now stepped forward as potential saviors. They offered buyouts, emergency loans, and restructuring plans that positioned them once again at the center of American finance. These moves were framed as stabilizing acts, but they also marked a deliberate reclaiming of influence. The balance of power was shifting, and the moment favored those with deeper pockets, broader networks, and a reputation for weathering storms. Lawmakers moved quickly. Hearings convened to examine the causes of the collapse. Experts testified about inadequate reserves, concentrated risk, and the challenges of managing rapid expansion without oversight. Advocates for reform argued that regional banks had exposed systemic vulnerabilities that could no longer be ignored. Their opponents insisted the failures were isolated, warning that heavy regulation would smother the very institutions that had empowered local economies. But the momentum had changed. The crisis had revealed too much, too clearly. In the months that followed, new standards emerged, capital requirements, reporting rules, and guidelines designed to prevent institutions from growing beyond what their structures could safely support. Some regional banks adapted and survived, becoming stronger under the new framework. Others faded, absorbed by larger institutions, or dissolved by the pressures they could no longer bear. The quiet rise of regional titans had reached its peak, and in its aftermath, the contours of American finance shifted once again. Looking back, their story reveals a powerful truth. Every wave of innovation carries its own risks. Regional banks transformed the frontier, empowered communities, and reshaped the balance between local and national power. But their rise also showed that growth without guardrails can falter under its own momentum. The legacy they left behind, part triumph, part warning, still echoes through modern banking, reminding us that strength is measured not only by ambition, but by the foundations built to sustain it.